Hello, and welcome back to Forex School from Pip Insight. This is the complete Fibonacci course, retracement and extension, from first principles to a fully worked example. Here's the roadmap. We'll start with where these famous ratios actually come from, and we'll be honest about the maths versus the mythology. Then the skill most people get wrong, anchoring a retracement correctly. From there we'll turn the 38.2, the 50 and the 61.8 into a pullback map for trending markets, add the ingredient that makes any level worth watching, Confluence with real structure, and use extensions to project targets before the market gets there. We'll walk one complete worked example end to end, then close with the honest chapter on when Fibonacci fails. Everything in this course is education, not financial advice. Notebook out, charts open, let's begin. First, the origin story, because a tool is far easier to trust once you know exactly what it is, and what it isn't. The story begins with a 13th century Italian mathematician, Leonardo of Pisa, better known as Fibonacci, and a deceptively simple sequence, 1, 1, 2, 3, 5, 8, 13, each number the sum of the two before it. Divide any number in the sequence by the one that follows and the answer settles towards 0.618, the golden ratio. Skip a place and you get 0.382, run the division the other way and you find 1.618. That arithmetic is genuinely elegant and completely real. And notice something already, the 50% level traders use every single day is not a Fibonacci number at all. It earned its place on the chart a different way, and that is a clue to how this tool really works. Now the honest part, because this channel doesn't do mysticism. Sunflower seeds and spiral shells really do follow golden ratio geometry. There is no comparable law of nature that makes a currency pair reverse at 61.8% of a swing. The evidence for any special, inbuilt market magic is contested at best. So why do these levels matter so often in practice? Because everyone is watching them. Fibonacci tools ship with every charting platform, millions of traders drag them across the same obvious swings, and their orders cluster at the same handful of prices. A level the whole market watches becomes a genuine decision point, self-fulfilling rather than supernatural. That distinction doesn't weaken the tool. It tells you exactly how to use it, as a map of attention, never as a prophecy. Next, the skill that decides everything downstream, where you anchor the tool. This is the single most common mistake in Fibonacci trading. The retracement tool asks you one question: which move are we measuring? In an uptrend, the answer is the impulse. Anchor the tool at the swing low where the move was born and drag it to the swing high where it topped, wick to wick, and keep that convention every single time. In a downtrend, mirror it, swing high first, then down to the swing low. The classic error is anchoring the wrong swing, a minor wiggle instead of the dominant impulse, or measuring bottom up when the trend is falling. Get the anchors wrong and every level that follows is wrong with them, drawn with total confidence in entirely the wrong place. The right swing is almost always the obvious one, the leg a child could point to. Let's anchor one properly. This market sells off into the candle marked low, which bottoms at 125 exactly. That's our first anchor, the birthplace of the move. From there, 7 strong candles climb without a single scare, and the candle marked high wicks up to 130 exactly before the buyers finally pause. That's the second anchor, the top of the impulse. Low to high, wick to wick, 500 pips of trending market. The moment the anchors are set, the tool does the rest for you. The 38.2 shades in at 128.09, the 50 at 127.50, and the 61.8 down at 126.91. Notice what we measured, the whole impulse, not the last little wiggle. That choice is the entire skill. Here's how those 3 levels become a working map. Trends move in breaths: impulse, pullback, impulse, and the retracement grid tells you where each breath intends to end. A shallow pullback that holds the 38.2 speaks of a powerful trend, where buyers are too impatient to wait for better prices. The 50 is the crowd's halfway house, watched even by traders who have never opened a Fibonacci tool in their lives. And the 61.8 is the deep retracement, the trend's last stand, where a healthy pullback ends and below which the whole move starts to look like a reversal instead. Treat the 3 as a corridor of interest rather than laser lines. Price routinely overshoots one level and respects the next. Same chart, and now watch the map earn its keep. From the high at 130 exactly, the pullback begins, and the first thing to notice is what it ignores. The 38.2 at 128.09 barely slows it down. The 50 at 127.50 holds for just one candle, whose low stalls 2 pips above the line before the slide resumes. Then the candle-marked retest reaches the 61.8, its low touches 126.91 to the pip, and everything changes. The selling dries up, the candle closes back up at 127.14, and the next 3 candles march the market straight back towards the highs. Deepest level tested, trend still intact, that is the 61.8 doing precisely what this framework asks of it. Now the idea that separates decoration from signal, Confluence, where a Fibonacci level lands on structure the market already respects. A retracement level on its own is just arithmetic, one opinion about one swing. What turns it into a signal is agreement. When the 61.8 of an impulse lands on something the market already respects, an old resistance that broke and should now act as support, a prior swing point, the origin of a breakout, 2 independent reasons for orders are now pointing at the same few pips. That overlap is confluence, and it is the real lesson of this course. Traders using Fibonacci well aren't asking whether price has reached a ratio, they're asking whether the ratio lands where structure already lives. One without the other is a line on a chart. Together, they make a zone with a story behind it. Here's confluence forming in real time. Early on, this market stalls twice at the same ceiling, 127.60, then a pip shy at 127.59. Resistance, tested and respected. The dip that follows bottoms at 127 exactly, and from there buyers break straight through that old ceiling, the close marked BOS confirms it. The impulse tops out at 128.60. Now the arithmetic, the 61.8 of that 160 pip leg sits at 127.61, a single pip above the broken resistance. Fibonacci level and roll reversal support, stacked in the same breath of price. The pullback arrives, the candle-marked retest dips to exactly 127.61, and the zone holds. 3 candles later the market prints a fresh high. That isn't the ratio working alone, it's 2 independent reasons agreeing. Retracements answer the first question, where might the pullback end? Extensions answer the second, if the trend resumes, where might it be heading? The method is the same tool stretched further, measure the impulse, then project beyond it. 127.2% of the leg, measured up from the swing low, gives the first objective just past the old high, the conservative target. 161.8% gives the golden extension, the classic destination for a full trend leg. Traders using this framework plan exits at these levels for the same reason they trust the retracement grid. Enough of the market projects the identical prices that profit-taking clusters there. A target, though, is a plan, never an entitlement. Watch both targets get written down in advance. The impulse runs from 126 exactly to 127 exactly, a clean 100 pip leg. The pullback obeys the map we've already built, it ends at the 61.8, 126.38, where the candle-marked retest turns. From those 2 anchors the projections are fixed before the move even resumes, the 127.2 extension lands at 127.27, and the 161.8 sits up at 127.62. Now watch. The rally clears the old high, and the very next candle stalls with its high at exactly 127.27, first target tagged, a 2-candle pause. Then a second push, and the candle-marked high wicks to 127.62 to the pip before sellers finally take over. 2 exits, both known in advance. Time to put every chapter together, 1 market, 1 impulse, 1 plan, from the first candle to the last. Everything here is a constructed illustration for education, not a live trade. The scene, a market grinding upward into a ceiling. Twice it stalls there, 128.41, then a pip beneath at 128.40. Resistance, twice respected. The dip that follows bottoms at 127.80, remember that price, it's our first anchor. Then the impulse, buyers drive straight through the ceiling, the close mark BOS confirms the break, and the leg finally tops at 129.40, anchor number 2. Now the whole plan writes itself before the pullback even starts. The 61.8 of that 160 pip impulse sits at 128.41, landing, to the pip, on the broken resistance. Fibonacci level, roll reversal support, and a rising market, all pointing at the same price. That's the zone. Next chart, we watch what happens there. Part 2, the test, and the target. The pullback unwinds for 3 candles, each low deeper than the last, heading straight for the zone. The candle marked retest is the moment of truth, its low prints 128.41 exactly, the 61.8 and the old ceiling in a single price, and the buyer's answer at once, closing the candle back at 128.56. From that hold the trend resumes, 2 strong candles, then a close above the old high at 129.40, a break of structure confirming the pullback is finished. And the destination was already on the chart. The 127.2 extension of the impulse projects 129.84, and the candle marked target touches 129.84 to the pip before profit taking arrives on cue. Anchors, zone, hold, target, the whole course on one chart. And now the chapter every honest course needs, what this tool cannot do, and the charts where it simply doesn't work. Let's be straight about the limits. A retracement grid paints 5 or 6 lines across every swing, and price has to stop somewhere, so in hindsight, some ratio always looks prophetic. That is selection bias, not evidence. Studies hunting for special reversal power at Fibonacci ratios have come back mixed at best. What survives scrutiny is the humbler claim from Chapter 1, widely watched prices attract orders. Which means a fib level with no structure behind it is decoration, an arbitrary line that happens to carry a famous name. The discipline that keeps the tool honest is the Confluence filter. A ratio only earns attention when it lands on independent evidence, and even then it marks a place to plan, never a promise that price will turn. Here's what failure looks like, because you will meet it often. A tidy impulse from 128 exactly up to 129 exactly, Anchor's textbook, grid drawn, 38.2 at 128.62, 50 at 128.50, 61.8 at 128.38. The pullback begins, and pays attention to none of it. The 38.2 is brushed aside. The candle-marked slice cuts straight through the 50 and closes beneath it without so much as a pause. The 61.8 goes the same way one candle later, and by the bar-marked low the market is trading beneath the very low the grid was anchored to, a full retracement and beyond. Every line was drawn correctly, there was simply no structure underneath any of them, and arithmetic alone held nothing. This chart is why Confluence is not optional. Let's fold the whole course into one view. The ratios come from real mathematics, but their power on a chart comes mostly from attention, millions of traders watching identical prices. Everything starts with the anchors, swing low to swing high across the dominant impulse, wick to wick, the same way every time. The retracement grid then becomes a pullback map, 38.2 for strong trends, 50 for the crowd, 61.8 for the deep test, read as a corridor, never as laser lines. A level earns real interest only through Confluence, when it lands on structure such as old resistance turned support. Extensions project the destination, 127.2 and 161.8, before the move resumes. And when there is no structure beneath the arithmetic, expect the market to slice straight through. And that completes the Fibonacci course. You can now anchor a retracement the professional way, read the pullback corridor inside a trend, demand confluence before any level earns your attention, and project extension targets before the market gets there. Your homework: pick 3 trending charts, mark the dominant impulse on each, and note whether the pullback respected your levels, and, crucially, whether structure was there when it did. If this course helped, subscribe and turn on notifications so you don't miss the next one, because it builds directly on these ideas. One reminder that never gets old: everything in this series is education, not financial advice. No method is a promise of profit, and trading carries real risk of loss. Practice on a demo account first. Thanks for studying with me, and I'll see you in the next course.